Hey, what's up, you guys? Welcome back to another video. And in this one, I want to talk about the backtracking of Japanese central bank and its impact on the stock market going forward. So we all know that the Japanese stock market had a meltdown last Monday. And of course, the Japanese government took note of that and it got spooked by the meltdown so much that it's now playing cool on more interest rate hikes. So just last week, the Bank of Japan hiked interest rates and struck a hawkish stance that signaled more increases ahead following years of ultra-low and even negative rates. The move, along with investors' concerns about tech and other macro themes, sent the global stock markets tumbling on Monday. So on Wednesday, Shinichi Uchida, the deputy governor of the Bank of Japan, said the central bank would not hike rates when the financial and capital markets are unstable. So they pretty much walked back on their own stance. He said that I believe the banks need to maintain monetary easing with the current policy interest rate for the time being, with developments in financial and capital markets at home and abroad being extremely volatile. That comment was a strong dovish signal that played down the chances of near-term rate hikes and in such volatile markets. Uchida's statement came after Monday's massive meltdown in the global stock market that some analysts blamed on the Japanese central bank's rate hike that unraveled yen carry trades. This tipped global markets over the edge amid existing concerns over the US economy because just in the last week, the US reported a very bad jobs report, so that also contributed to the sell-off. It's not the first time Japanese officials have sought to calm the market turmoil that sent the Nikkei to its worst one-day percentage loss since Black Monday in 1987. On Tuesday, Japanese officials from its finance ministry, financial regulator, and BOJ met to discuss the massive sell-off. Uchida's dovish signal on Tuesday boosted Asian shares, and on Wednesday, Japan's benchmark Nikkei index jumped as much as 4% to close 1.2% higher. Since its rebound on Tuesday, it has regained most of its losses from Monday. Meanwhile, the yen lost over 2% against the US dollar. However, the yen carry trade risks remain. Despite the BOJ's cooling attitude on rate hikes, there are still risks associated with the yen carry trade, which could further unwind if the Fed cuts rates rapidly. The trading strategy involves borrowing cheaply in Japan's ultra-low interest rate environment and using the funds to invest in higher yielding, such as US stocks and elsewhere. Nobody seemed to know how much carry trade is at stake. Bloomberg estimates there could be trillions at stake, pointing to potential complications. JP Morgan strategist has said that the carry trade unwind is only half done. It could complicate the Fed's interest rate decisions. The US central bank recently signaled that it could start cutting rates as soon as September. The natural reaction from the Fed to soft labor market data and fresh recession risks would be to cut rates and to do so relatively rapidly. But this would exacerbate any carry trade unwind. So there you have it. The reaction from the Japanese central bank and its further implications in the global stock market. I hope you find the information valuable. And if this video helped you in any way, feel free to click the like button and leave any comment down below. I personally answer to all the comments. So with that being said, thanks again for watching, and I'll see you in my next video.